Well, we got a milestone in the currency markets today that we want to talk about. The euro hitting parity with the U.S. dollar for the first time in 20 years. Let's bring in Jens Nordvig, founder and CEO of Exante Data. And Jens, you think parity isn't the last stop here? It's going to go through.
Well, we have an extremely unusual situation on our hands in Europe. Right? We have a war right next to the EU. We have Russia that is essentially trying to create as much pain as it can for the European economy deliberately. It's not a normal situation, right? And the euro is trading accordingly, not normal. It's 20 years ago since we were here last time. Last time it was because some very special capital flows. This time around, there's a very fundamental reasons why we're here. So there's not really any good reason to fade it unless we see something new on the energy front.
Jens, it's Tim. How about the dollar-yen component of the dollar's move? Because BOJ's been missing in action, claiming they see zero inflation there. And while the dollar basket is certainly 60% euro, the move in dollar-yen has been extreme. I'm just curious if you think that's going to give ground.
Yeah, so if you look at this year, initially, the dollar was strong because the Fed was hawkish and a lot of currencies that were very sensitive to Fed policy moved a lot, such as dollar-yen. In the last couple of weeks, we've started to see something different. Dollar-yen is starting to stabilize a little bit. And what you're seeing is that it's the growth-sensitive currencies, especially some EM currencies, that are taking a major, major hit. So we're in a transition phase. The dollar has been strong through both phases, but it's strong against different currencies. And we're having something that smells a bit like an EM currency crisis now, really for the first time in a long time.
Yeah, that was going to be my question, Jens. Emerging markets, obviously, are going to get eviscerated on the back of something like this. EEM is going, I think, from 60 down to current levels over the course of about a year and a half. I mean, how does that play out? Because, quite frankly, it can't be bullish here back in the United States at a certain point.
Yeah, so I think what worries me about this cycle, right, is that normally when we have significant pressure on asset prices, we have somebody is going to come in and help, right? We are used to the global central banks coming in and helping, or China coming in and helping. China's trying, but not very successfully, to get something going in China. And then you look at all the global central banks, they're still in tightening mode. We're not going to have like a big pivot from central banks like soon, right? Maybe we'll have something later this year, but for now, the central banks are kind of forced to stick to a hawkish tone because the inflation is so high. So that's what's worrying, that this could be a pretty drawn out situation with not really any clear catalyst for relief, I would say, in the next couple of months.
Are we going to start talking, Jens, about, I don't know what the way today you refer to, pigs. Once upon a time we talked about the pig countries and their debt loads, and I'm wondering if that becomes an issue once again here.
Yeah, so we've already seen that the sovereign bond spreads in Europe have widened out pretty meaningfully this year, and the ECB is preparing a certain tool to fight that already, right? So this is already a concern. And as long as the ECB is in tightening mode, which will be the case as long as the inflation it doesn't look like it's coming down very materially, that's going to be an issue. And that's also something that was different. Like 20 years ago, when the euro was down at these levels, we didn't have sovereign bond spreads blowing out. It was actually a pretty orderly decline all along. So from that perspective, this move here is quite a bit more concerning than the one we had 20 years ago.